Ladies and gentlemen, buckle up, because today on Boss Economics World, we're diving headfirst into the steaming pile of economic nonsense that is the European Central Bank's latest circus act. Oh yes, the ECB is back at it, folks, preparing to slash interest rates yet again, all while whistling past the graveyard of a looming recession, courtesy of a toxic cocktail of bad government policy, trade wars, and sheer central bank cluelessness. And don't worry, we've got the receipts, fresh data, scorching examples, and enough satire to make even the most stoic banker cry into their overpriced latte. So, grab your pitchforks, or at least a calculator, because it's time to expose the ECB's latest masterclass in economic mismanagement, and why you should be mad as hell about it. Let's start with the headline that's got the financial world buzzing like a beehive on a sugar high. European central bank officials are gearing up to cut interest rates further, potentially down to 1.5% in 2025, because, apparently, the Eurozone economy is about as sturdy as a house of cards in a windstorm. Why? Well, according to the ECB's own tea leaves, the economy is bracing for lasting damage from US tariffs, even if the Trump administration decides to play nice in the coming weeks. Spoiler alert, they probably won't. And guess what? This comes hot on the heels of intense meetings at the International Monetary Fund, where policymakers left Washington feeling more disillusioned than a kid who just found out Santa isn't real. Now, let's break this down, Boss Economics World style, from the surface-level clownery to the deep-rooted economic rot. Because, folks, this isn't just about a few basis points here and there, this is about a systemic failure of government and central bank policy that's driving the Eurozone straight into the ditch. First off, let's talk about ECB President Christine Lagarde, who's out here playing the monetary policy equivalent of, "I'm just a girl," with her now infamous line, "When the size and distribution of shocks are highly uncertain, we cannot provide certainty by committing to a particular rate path." Oh, bless her heart. Translation, folks. We have no idea what we're doing, so we're just gonna wing it and call it data dependency. Data dependency in the extreme? More like desperation in the extreme. Here's the deal, the ECB is staring down the barrel of an 8-quarter-point rate cut in June 2025, bringing the deposit rate from its current 2.25% to a measly 1.5% or lower. Why? Because the Eurozone economy is tanking faster than a lead balloon, and the ECB thinks slashing rates will magically fix everything. Spoiler alert, it won't. But hey, at least they've got their buzzwords, agile and active monetary policy, as Finland's central bank head Olli Rehn put it. Agile? More like aimless. Active? More like actively digging their own grave. Now, let's dig into the first layer of this economic onion, the US tariffs that are apparently the boogeyman under the ECB's bed. According to the suits at the ECB, Donald Trump's unpredictable trade policies are feeding uncertainty, damping spending and investment, and ultimately inflation. Gee, you think? Let's talk numbers. The US has already slapped tariffs of up to 25% on European goods, from German cars to Italian cheese, under Trump's America First agenda. And with Trump's 90-day negotiation respite not ending until early July 2025, the Eurozone is stuck in limbo, wondering if the tariff hammer is going to drop even harder. But here's the kicker, folks, this isn't just Trump's fault. Oh no, the Eurozone's own governments have been asleep at the wheel, failing to diversify trade partnerships or build resilience against external shocks. According to the World Trade Organization's latest 2025 report, the Eurozone's exports to the US account for 20% of its total exports, double its exports to China. So, when Trump sneezes, the Eurozone catches a cold. And instead of, maybe negotiating better trade deals with Asia or boosting intra-EU trade, what do Eurozone governments do? They cry to the ECB to fix it with lower interest rates. Brilliant. It's like trying to fix a broken leg with a band-aid. Next up, let's talk about the euro's appreciation, which the ECB claims is weighing on prices and strengthening the case for rate cuts. Oh, the poor, strong euro, making European exports more expensive and imports cheaper, thus dragging down inflation. But wait a minute, why is the euro appreciating in the first place? Could it be bad fiscal policy? Ding, ding, ding. Here's the deal, Eurozone governments have been on a fiscal spending spree, racking up deficits like it's going out of style. According to Eurostat's latest 2025 data, the Eurozone's average fiscal deficit has ballooned to 4.2% of GDP, up from 3.6% in 2024, thanks to increased spending on defense, hello, Ukraine war, and green infrastructure, hello, net zero pipe dreams. Now, in theory, fiscal expansion should boost demand and inflation, right? Wrong. Because when you pair that with tighter financing conditions, think higher borrowing costs due to rising bond yields, you get a recipe for economic stagnation. And guess what? A strong euro is just the cherry on top, making Eurozone exports even less competitive. So, what's the ECB solution? Slash interest rates to weaken the euro, of course. Because why fix the root cause, reckless government spending, when you can just kick the can down the road with monetary policy? Classic central bank logic, folks. And let's not forget, a weaker euro means higher import prices, which could actually increase inflation down the line. But hey, who needs foresight when you've got data dependency? Now, let's peel back another layer, the drop in energy prices, which the ECB says is also dragging down inflation. According to the International Energy Agency's 2025 outlook, European natural gas prices have fallen by 15% year-on-year, thanks to a mild winter and increased LNG imports. Sounds like good news, right? Cheaper energy, lower costs, happy consumers. Wrong again, folks. Because in the Eurozone, lower energy prices are actually a symptom of a deeper problem, government mismanagement of the energy transition. Remember the EU's Grand Green Deal, the one that was supposed to make Europe a renewable energy paradise by 2030? Yeah, well, it turns out that shutting down nuclear power plants, looking at you, Germany, and dragging your feet on renewable infrastructure doesn't exactly make for a stable energy market. According to a 2025 report by the Bruegel think tank, the EU's renewable energy capacity grew by a measly 8% in 2024, far below the 15% needed to meet its net zero targets. So, instead of energy independence, the Eurozone is still at the mercy of global energy markets, and now, with prices dropping, inflation is taking a hit, and the ECB is panicking. But here's the real kicker, lower energy prices should be boosting consumer spending and business investment, right? Wrong. Because Eurozone governments have piled on so many taxes and regulations, think carbon taxes and ESG mandates, that businesses are too busy drowning in red tape to invest, and consumers are too broke to spend. According to the European Commission's 2025 Consumer Confidence Index, consumer confidence in the Eurozone is at its lowest level since the 2020 pandemic, clocking in at -18.3. So, instead of an economic boost, we get stagnation, and the ECB's response? You guessed it, lower interest rates. Because nothing says economic recovery like negative real rates in a stagflationary mess. Now, let's zoom out to the big picture. The Eurozone's growth outlook is so bleak, it's practically a horror movie. According to the IMF's latest 2025 projections, Eurozone GDP growth has been downgraded to a pathetic 0.8% this year, down from 1% just a few months ago. And the Purchasing Managers' Index, PMI, for April 2025? A dismal 47.2, signaling contraction for the umpteenth month in a row. Translation, folks. The Eurozone economy is on life support, and the ECB is out here playing doctor with a butter knife. But here's the thing, this isn't just about tariffs or energy prices or a strong euro. This is about a systemic failure of government policy across the Eurozone. Take Germany, the so-called economic powerhouse of Europe. According to the status, Germany's industrial production fell by 4.6% in Q1 2025, thanks to a perfect storm of high energy costs, red tape, and a collapse in export demand. Or look at France, where President Macron's latest labor reforms have sparked strikes so massive, they've shut down half the country's transport network, per a 2025 OECD report. And don't even get me started on Italy, where public debt is now at 145% of GDP, according to Eurostat, making it a ticking time bomb for the entire Eurozone. So, what's the ECB's big plan to fix this mess? Slash interest rates, of course. Because nothing screams economic recovery like throwing cheap money at a structural dumpster fire. Meanwhile, Eurozone governments are out here pretending everything's fine, racking up deficits, slapping on more regulations, and crossing their fingers that the ECB will bail them out. Spoiler alert, it won't work. Just look at Japan, folks, decades of zero interest rates, and their economy is still stuck in the 1990s. But hey, at least the ECB's got agile and active monetary policy, right? Here's the bottom line, folks, the Eurozone's economic woes aren't just about Trump's tariffs or energy prices or a strong euro. They're about a systemic failure of government policy, decades of overspending, overregulation, and underinvestment in the things that actually matter, like infrastructure, innovation, and trade resilience. And instead of owning up to their mess, Eurozone governments are dumping it all on the ECB's doorstep, expecting Christine Lagarde to fix it with her magic interest rate wand. Spoiler alert, she can't. And let's not forget, folks, the ECB isn't exactly innocent here either. By slashing rates to 1.5% or lower, they're not stimulating demand, they're just fueling asset bubbles and punishing savers. According to a 2025 report by the Bank for International Settlements, ultra-low interest rates in the Eurozone have already driven a 20% increase in real estate prices since 2020, pricing out young families and inflating wealth inequality. Meanwhile, savers are earning negative real returns, with inflation at 2.1% and deposit rates at 1.5%. But hey, who needs savings when you've got agile monetary policy, right? So, what does this mean for you, the everyday investor or finance pro watching Boss Economics World? First off, get mad. Get mad at the Eurozone governments who've spent decades digging this economic hole, and get mad at the ECB for thinking lower rates are the shovel to dig us out. Second, get smart. If you're holding Eurozone bonds, watch out, yields are tanking, and with inflation ticking up, you're looking at negative real returns. If you're in equities, brace yourself, lower rates might juice stock prices in the short term, but with growth at 0.8% and tariffs looming, it's a house of cards. And if you're a saver, well, sorry, pal, you're getting hosed. But most importantly, folks, get loud. Demand better from your governments. Demand fiscal responsibility, not reckless spending. Demand deregulation, not red tape. Demand trade resilience, not tariff dependence. Because if there's one thing Boss Economics World has taught us, it's this: bad policy makes bad economies, and it's up to us to call it out. Well, folks, that's all for today's episode of Boss Economics World, where we roast bad policy and toast economic truth. If you liked this scorching takedown of the ECB's latest clownery, smash that like button, ring that bell, and share this video with every finance bro, saver, and taxpayer you know. And remember, in a world of economic nonsense, stay savvy, stay skeptical, and always follow the money. Until next time, this is your host, signing off, because unlike the ECB, I know when to quit.